Welcome to this explainer. Today we're diving into some fascinating and honestly kind of shocking data about how traditional mortgages actually work. If you own a home or if you're planning to, the concepts we're exposing today completely flip the script on managing your cash flow. It is a genuine paradigm shift. We're going to look closely at the hidden costs of traditional loans and how you can totally optimize your money to keep more of it in your own pocket. Okay, let's dive right into this roadmap. First, we'll uncover the interest-heavy slog. Then we'll introduce the all-in-one solution. After that, we'll hit the top 10 AIO strategies, run through a real numbers case study, and wrap it all up with your next steps.
Section 1. The interest-heavy slog. When you break down a traditional 30-year loan, the bank's big secret isn't really the interest rate, it's the volume of interest. Think about this. In year 2, a staggering 81.4% of your payment is going strictly to interest. That leaves a measly 18.6% for the principal. And fast forward to year 10, 70 cents of every single dollar is still just feeding the bank. 10 years in, and you're basically, well, actually, scratch that. You are literally just renting your money from the lender. It's wild to see the math laid out like this.
Now, what's really interesting about this concept is what we call the 75% principal threshold. This is that magic moment where 3/4 of your payment finally goes towards your own equity instead of interest. But here's the kicker. With a traditional loan sitting at a 6% to 6.25% rate, you are waiting a quarter of a century to hit that mark. No way, right? 25 years of an interest-heavy slog before your monthly payments are actually working primarily for you? It really puts the painful cost of a standard amortization schedule into perspective.
So let's look at the structural friction happening here. It's like a giant puzzle where the pieces are purposely working against you. With a standard mortgage, your money is completely segmented. You've got this massive interest drain early on and painfully slow equity building way late in the game. But the real friction, that's happening right in your checking account. Your cash is just sitting there idle, earning a microscopic 0.01%, which is, enough to maybe buy a cup of coffee every 5 years? While you're simultaneously paying 6% or 7% on your home loan, your own cash is doing absolutely nothing to help you pay down that debt.
Section 2. The all-in-one solution.
So, what does this all mean? What actually is this all-in-one or AIO solution? Well, it's a first-lien home equity line of credit, a HELOC, combined directly with the fully integrated sweep checking account. It's a real game changer because it completely reimagines how your wealth, your cash flow, and your debt all interact. Instead of that standard sluggish monthly amortization, this system calculates daily simple interest, meaning every single dollar you deposit immediately reduces your principal balance, knocking down your daily interest charges the very second it hits the account.
And it's not just about paying off debt fast. We really have to talk about the absolute power of liquidity. The AIO isn't just a payoff tool. It's this incredibly powerful safety net. Since it functions as an open line of credit, it acts as a ready capital fund, giving you a full 30-year window of protection. Your money stays fully liquid. This is absolutely crucial because it means your cash isn't trapped behind a costly refinance wall. It's right there, accessible for emergencies or, better yet, for jumping on sudden investment opportunities.
Section 3. Top 10 AIO strategies.
Okay, let's chunk this down into actionable steps. Step 1 is executing the 100% income sweep. Traditional banking separates your income from your debt, so you lose leverage. But with the AIO, you drop your entire paycheck directly into the loan account. This instantly drives your balance to its lowest possible point, absolutely crushing that daily interest. Step 2, leverage your idle cash. Think about those emergency funds or tax reserves you just have sitting around. Parked inside the AIO, they suddenly become a 24/7 buffer, actively suppressing your mortgage balance and stopping compound interest debt in its tracks. And this brilliantly illustrates Strategy 3, which takes things even further through credit card arbitrage. Instead of paying daily expenses from your cash right away, you route 100% of your living expenses through high multiplier rewards credit cards. Because you do this, your cash stays inside the AIO account for an extra 30 to 45 days, suppressing that daily interest balance even further. Then, at the end of the billing cycle, the sweep functionality just pays off the credit card in full. You get the rewards points, and you're utilizing institutional money to float your daily life while your own money fights your mortgage.
The flexibility of this whole shebang is just incredible. For the remaining strategies, you can direct lump sum windfalls, like bonuses, to instantly cut interest. You completely eliminate the structural friction of amortization. You can easily consolidate non-housing debt, self-fund investments, bypass refi costs entirely, and smoothly offset fluctuating income if you're on commission. Ultimately, you execute what's called compound velocity, which frequently cuts a conventional 30-year payoff down to just 8 to 12 years, all without changing your current lifestyle.
Section 4. Real numbers. Case study.
Let's anchor this in reality with a $567,000 loan balance. The side-by-side contrast here is mind-blowing. On a standard 30-year fixed loan, this family is looking at a $3,491 monthly payment, handing over roughly $689,000 in total interest over 3 decades. But look at the AIO setup. This household brings in $12,000 a month and spends $9,000, leaving $3,000 in positive cash flow sweeping into the account. By leveraging daily simple interest, their total interest paid plummets to just over $181,000, and their payoff time, an astonishing 9.6 years. Thanks to that cash flow, their effective APR is driven all the way down to a tiny 1.944%.
So the crucial point is right here, $508,008.07. That is massive interest savings achieved just by switching to the simple interest math of the AIO. To put that into perspective, that's over $500,000 that stays right in your family's net worth instead of being funneled directly to the bank.
But we definitely don't stop at the payoff. Let's talk about what happens next. Over $2.6 million. If this family takes that old traditional mortgage payment of $3,491, which they don't have to pay anymore after month 116, and redirects it into an S&P 500 fund earning a historic 10% from month 116 to year 30, the results are absolutely staggering. They build over $2.6 million in wealth accumulation. They end up with a massive investment portfolio and a fully paid off home, instead of just finally owning their home at year 30.
Section 5. Your next steps.
Now, to successfully execute these exact strategies, you really need an expert guide. That's where Eric Walbot comes in. He's a mortgage strategist and AIO specialist at the Payoff Pros. He specializes in this exact daily simple interest math, custom fitting the AIO framework to your specific income, your idle cash, and your spending habits, so you can replicate the kind of crazy velocity we just saw.
So your next step is really straightforward. Schedule a Zoom to run your own numbers or set up a coffee meetup with Eric. Every single household's cash flow is unique, so seeing your specific timeline is key. I'll leave you with this one thought to consider. Do you want to spend the next 30 years quietly feeding the bank's bottom line with the fruits of your labor? Or are you ready to change the flow of your money and build your own freedom? The choice is yours. Thanks so much for joining me for this explainer, and keep exploring.